right.
Rock and roll.
Here we are. So
here we are again.
We got to say that with full disclosure, we're recording this thing after the close on Thursday. So
do we really have to disclose that?
Yeah, because I
we don't know what's going to happen tomorrow.
That's why.
Yeah, Jerry's heading up to do some traveling, and we decided not to do it long distance or whatever, virtual. We wanted to do it in person, so we felt pretty confident that the world won't end tomorrow.
I hope not. It ended today. The world was all good yesterday.
So here's the important thing, and then we lose track of this sometimes on the show. So if you guys watch the show and you think to yourself, man, what if something crazy happens and I don't hear about it till a whole week and a half away? Well, if you're a member, Jerry always does the newsletter, obviously after the market closes, and he's had all weekend to do the analysis, and he digs into it. So when you go to the newsletter and you go to the newsletter video, you're going to get all the info. So if we don't have it here, sorry, this is free.
Yeah, right. Yeah,
so
we need a little bit of flexibility on this one.
You get what you get. We have to have a little flexibility.
Yeah, but the newsletter is
that's where the gold is.
It is indeed.
So what do you got?
So, all right, we'll get to it when we get to it. TSP Weekly Update Show, 8 May 2022. So this week we're going to take a look at Fed funds rate. Why would we do that? It was a huge Fed meeting on Tuesday and Wednesday. The Fed came out on Wednesday afternoon, and then the world went sideways. So we'll talk about that when we get to the slide. And then we're going to look at something I put out last week if you remember, you got it in the newsletter. I did a pretty solid deep dive analysis into one of the tools that we use. It's called the Relative Strength Index. RSI. It's a good one, and I'm going to go over it here with you guys. And then gold, GLD is
I thought that was a good-looking dude.
Hey, pretty spicy today, ain't you? So gold, inflation is going through the roof, and everybody knows that gold is a hedge against inflation, right?
Until it's not.
I mean, the things that are as true as gravity never cease to amaze me. I mean, until gravity flips the other way, I'm convinced that that's probably true. Anything in the financial world, anybody that says I believe X, just makes me want to go the other way. And then we'll look at the TSP fund charts, which I had to redo at the end of the day today, and because yesterday it was showing a much different thing, and so who knows what's going to happen tomorrow? But we get it through basically Thursday. Okay, Fed funds rate. So the Fed funds rate. I'll have to come back to that. Fed funds rate is the rate that banks lend money to each other, right, on an overnight basis. And then when you hear the Fed is going to raise or lower rates, that's what they're talking about. They're talking about the amount of money that banks charge each other for overnight lending, and then that trickles down to, in a consumer way, to us paying higher or lower credit card, more or less for mortgage payments and more or less for car loans.
It's kind of fascinating. I mean, that banks charge each other an interest rate to move money back and forth, to lend to each other. Right? Because they have to meet certain thresholds by the end of the night, right? To satisfy all of these different regulations, right? And so I think it's fascinating anyway, but we're financial geeks, but so they have to meet this by the end of the night, right? And so a whole bunch of accountants every night are deciding whether they need to borrow money, lend money, whatever. But that's a rate they pay, which, as you would not be surprised, is really tiny.
Usually.
And it
has been.
And it increases, and I say tiny compared to what we pay.
Right.
So if we're at a 5% interest rate for a loan, they're probably like 0.5.
Yeah.
Right. They hook a brother up.
Yeah. They make the rules.
We get to pay for it. Really.
Yes, absolutely we do.
Yeah. All right, moving on.
So if we're looking at the chart here, right? Here's the big dilemma for going forward. This is a 25-year chart. Okay, so what happens is back here, as the stock market is moving higher on the tech boom, right, into 2000, the Fed sees that the economy is overheating, and it raises rates. When the Fed raises rates, it's more expensive for companies to buy their stock back or take loans or whatever. So it's taking money out of the system. So when the Fed raises rates, then it leveled off and we had the tech crash. And as the tech crash starts happening, the Fed is reducing rates because it's trying to not have the crash be too bad on the economy, right? So it reduces rates. So it gets down here to the bottom. And if you remember, the bottom was actually in 2003. So the Fed keeps rates low for a little longer. And then the economy starts picking up and we start having the housing boom, right? And as the housing boom gets into high gear, the Fed starts raising rates again. All good. Flattens out. Doesn't quite get as high as it was before, but flattens out. All good. Then we have the financial crisis. All the air comes out of the housing market. We have a big financial crisis, and the Fed real quick lowers rates all the way down to 0.25%. Okay? Then, if you remember, we get to the bottom here in 2009, and the stock market starts going back up. But the Fed never brought rates back up. Okay? So what does that mean? Back here, when we had the tech crash, the Fed was able to reduce rates to help the economy get back on its feet. Same thing after the housing crash, right? Then after in 2009, we bottomed out. The market starts going higher again. The Fed kept rates at zero, which was at 0.25%, which definitely added to this boom that we've had since 2009. Back in 2016-17, they started raising rates, and they had a thing called the taper tantrum. The stock market went a little bit sideways, so the Fed stopped raising rates. Okay, then we had COVID, and immediately went back down to 0.25 point. Then COVID, as we all know, lasted in terms of the stock market, the 35% drawdown lasted for about a month. And so after 2020, the market skyrocketed. And the Fed kept rates at 0.25%. So now the market is up here somewhere. Stock market, right? But the Fed, and it's rolling over. But the Fed it can't reduce rates because it's already at zero. And not only can it not reduce rates, it's telling us that the rates are going higher because inflation is high. So they're in a trick bag. They're really stuck.
This is where dogs and cats are flying. Like it's not supposed to happen this way.
It's not supposed to happen this way. But this is what you get from financial engineering.
They messed it up.
They messed it up back here. I mean, back here is when
they should have.
It should have been just like this.
Yep.
You should have had a thing just like that, and it would have been fine.
Yep.
But now we have nowhere to go, and we have inflation. Which, if you saw the Fed statement on Wednesday, it was actually really funny because the Fed chairman comes out and he's like, "I want to begin by addressing the American people," and I'm like, "Oh, he's running for president." Like, I mean, it wasn't like usual wonky talking to Bloomberg people. He was like, I want to start by talking to the American people. We understand that inflation is a big problem. Gas prices are high. Food is high. And that's our number one priority is reducing inflation. We're going to do we have the tools. We're going to do everything that can possibly be done to reduce inflation. And
how are you going to do that?
Well, and he talks about it, but, they're going to do it by raising interest rates, right? So they do the regular, the statement, like the prepared statement. Mm-hmm. Then they take a little break and they have a Q&A session with all the financial reporters, right? And he says that there was a the market is always trying to decide what the Fed's going to do. They're trying to predict what the Fed's going to do. And somebody had floated this narrative that they were going to do a 75 basis point interest rate hike on this or some future Fed meeting. And in the Q&A, he said, "Nah, 75 basis points is pretty much off the table. We're looking at doing 50 basis points for the next couple of meetings." So half an hour probably after that, maybe, the market exploded higher, right? So everybody's watching this. The market explode higher. Right. And I'm watching it on Bloomberg. And so, of course, these guys have to say why this is happening, right? So the only thing they can point to is that The market was at least somewhat pricing in a 75 basis point move, and they only got a 50, and then he said he was taking 75 off the table going forward, so therefore the market went higher. But if you can't have it both ways, you can't come on and say, I'm doing everything for the American people, and then have the stock market react the way it did.
Right.
Because
can't have both.
And you should know by the way the stock market reacted what the reality is, right? I mean, 50 basis points, at least as of yesterday, was okay because the market was up at the end of the day 3.5%. Then what happened over the I don't know, a couple of hours from the end of the day on Wednesday to the open on Thursday? I mean, I don't know what happened. I actually haven't been listening to Bloomberg all day today, so I don't know what the talking heads are why they're saying the market collapsed today.
What their reasoning is. Yeah,
I don't know. But the market was down today 3.5%, where, you know, I had a bunch of people on Facebook going, how come we're not in? The market's up 4% in the past week, you know, and all of it's gone today. The whole thing's gone today. I don't know what's gonna happen tomorrow.
Yeah.
But you can't play with this volatility in TSP.
Not in TSP. No. Now there's probably a lot of people that made some money if they played this right, you know, and other, you know, instruments outside of the TSP.
Well, if you were standing in front of your computer, looking at a 1-day chart minute to minute, you drew your trend lines and you did your thing.
Yeah.
Absolutely, you could have made a lot of money yesterday and today.
Right.
But that's not a TSP thing. Okay. Relative Strength Index.
RSI.
Yeah, it's a really good tool. So, Relative Strength Index has a handful of major uses. The big one we're going to take a look at is price divergence. But the indicator moves between 0 and 100, right? So it's an oscillator. It plots recent price gains versus recent price losses. RSI levels therefore help to gauge momentum. It's a momentum indicator, and it's trying to gauge the strength of that momentum in that direction. So most basic use of RSI is as an overbought or oversold indicator, which is useful. And just generally, they say when RSI is above 70, it means it's overbought. When it's below 70, it means it's oversold. And however, making the assumption is dangerous. So just because the RSI gets to overbought doesn't mean it's getting ready to roll over. And just because it gets below 30 doesn't mean it's getting ready to go higher. You want to see it cross those lines one way or the other as your indicator. Divergence is really the thing that we're going to focus on in the next couple of charts. That when the indicator is moving in a different direction than price, right? That's divergence, and it shows that the current price trend is weakening and could soon reverse. So we're going to have a few examples of that. And then the third use is as support and resistance levels. During uptrends, the stock will often hold above the 30 level and frequently reach 70 or above. And when it's in a downtrend, it's typically below 70 and frequently reach 30 or below. A lot of times when it's in an uptrend, it'll stay above 70 for a long time or stay below 30 for a long time if it's in a downtrend. All right, so and this is all from Investopedia. There's the link there. Here's the chart from Investopedia. And basically what they are, my pen is messed up again. Okay, so what they're trying to show is that here's the 70 line, overbought line, 30 line, oversold. So when we get below 30 down here, it's a lot of times a low, right? When we get back above 70, a lot of times that's a high. So that's what these are all pointing out. It's below 30, it's a low. Gets above 70, it's a high. So a lot of people use that as the sort of, I wouldn't use it as a trigger. Again, when RSI comes up, gets above 70, once it rolls over is really where you want to think about selling it. right?
It's a leading indicator, right?
It can be. It's happening at the same time. It's just the good thing about RSI is it tells you the strength of the momentum of the move. So if RSI goes up really fast,
right,
it means there's a lot of power behind that move. If it's going up, but it's just going up a little at a time. I mean, if price is going up a lot and RSI isn't going up much, that's telling you a lot, right?
Yeah.
And that actually goes to divergence. We're going to talk about that. So that's the general idea of using RSI above or below that 70 and 30 line. So in terms of divergence, let's take a look at a couple things. This was a chart. It's not that old. It's 6 months, but this is through the end of April. So all the stuff that's happened in the last week or so isn't on here. So here's the top in January. We had a first move down that was really strong, right? And it got us to oversold pretty quick. So you can see back here, we got to oversold about here in the move. So we still had a pretty good price move down while we stayed oversold, right? Once we got back above that 30 line, that's where the bottom was and started to tick back up. Okay, we never really did get significantly back above the 50 level, which is what I like to use as the trigger. But we got just barely above it, did a double top, rolled back down, made a lower low in price, but we made a higher low in RSI. Okay, that's the divergence. Price is going lower, but RSI is not making new lows. It's making higher lows. Okay. Comes up, we get another low. RSI came up, came down, and still put in a higher low than the last time. So it's the divergence is getting really clear, right? And that's what set us up for this big move higher in March. Okay, and then once we got above that 50 line, that's when I actually got back in. So it's definitely a useful tool. It's not an exact timing tool, but it's pretty useful. All right, so that was the bottom, kind of the setup for the most recent bottom in February, March. If we zoom out to a 1 year, so we can see how it works for tops, right? We had a top back here in early November, and we got overbought. Market comes down, comes back up, comes down, higher low, which is good. Now we have a new high. But we don't have a new high in RSI. So it's telling us that even though price is moving higher, it's moving higher, the weakness is increasing as price increases. So the strength of the move is decreasing as price goes higher, which basically means that the brakes are going on. The car is still moving forward, but you're braking. And eventually the car is going to start moving backwards, which is this, right? Then we had this big move like we just did. That was the last chart. Had the oversold, came back up, came down to lower price lows, but higher RSI. So there's the divergence, another lower low, another higher low in RSI, and we had the big jump in March. So it's not an exact timing tool, but it's definitely useful. What does it look like for COVID? We had a top here in the market in January 2000. We got to overbought. We got a higher high in February 2000, but we had a lower high in RSI. So we get divergence. It has nothing to do with COVID. It was, COVID was probably in the news by then, but obviously the market hadn't rolled over yet. But for whatever reason, there's a whole lot less momentum behind this price move higher, right? A whole lot less momentum in January, February, and then the news about COVID comes out and it comes crashing down. We get oversold right here, which is pretty early in the move down, right? We got oversold like here. So if you had gotten back into the market just because RSI was below 30, it was not a good idea, right? That was just the beginning of the move lower. But we got oversold. We stayed there until the beginning of March, which was here. And then RSI started picking back up. And we got consecutive higher lows, even as price is moving way down. So again, it's not an exact timing indicator. That's why I said I like to use when it crosses that 50 line. Because when it crossed that 50 line, that was that breakout right there. That in my opinion, is the best time to get back into the market then. You don't get the bottom. There's no way with this methodology you're catching exactly that bottom. But it definitely anticipated the bottom by RSI increasing as price is decreasing. Okay, how about the top in 2007 and the bottom in 2009? Same kind of idea. We had a top up here in March of 07, May of 07. Price continues higher. RSI is decreasing. Market rolls over. We have a little opportunity in here where the market gets really oversold right here. We have a low, a price low, and that's the low right there. Recovers a little bit, comes down, puts in a new low, right, with a higher RSI. And that led to this move, which was 3 months long at about a 20% move, and it was one of the few tradable rallies that we had during that correction. And then at the very bottom, you got a big drop down in December of 08. You got a big oversold condition. You got lower price here and divergence with the RSI, and then that was the actual final bottom in 2009, and then it takes off from there. So it's not an exact tool, not exact timing, but it's a really, really good tool. So if you practice with it a little bit, it's probably a good idea. Okay. Bonus chart is GLD is the ticker symbol for the ETF for gold. Here's the chart back to 2008. So it just strikes me as odd that the conventional wisdom is that gold is a hedge against inflation. And I don't know. I mean, here's the bottom of the stock market basically in 2009. The market rallies, gold rallies with the stock market at the same time until 2012. Gives us a big cup and handle kind of thing, right? If you looked at that chart, if cup and handle is a pretty common, a lot of people know what that is. But one thing I wanted to point out about this chart in terms of a cup and handle, if we forget about the wick, right, the little lines on the top, the top of the closing candlestick is at 180. Okay, it's at 180. A cup and handle, you want a big run up on the left side, which we got. You want a pretty deep cup, and that is a really good shape for a cup, but you don't want the left side to be higher than the right side. And in this case, the left side is almost 190. That's the top of it. So you really don't want this cup, the right side of it to be higher than the left side, but that's what we got. So it puts that kind of cup and handle, makes it a little bit questionable. But then we get a pretty good handle, and a big false breakout right there. And this is on a monthly basis. So I would expect actually gold to go down from here. It's not a really constructive cup and handle pattern. And it doesn't seem to align with the idea of being an inflation hedge. So anyway, I wanted to show it just in terms of the cup and handle pattern and how you really have to look at, if you're going to do the cup and handle pattern, you definitely don't want the right side of the cup higher than the left side. All right. Okay. TSP fund charts. So honestly, I redid these this afternoon because I had done them last night and it looked much different. So this is the ones we always do, right? It's the 2-year weekly chart. Each tick is a week. Last night, this was a white candle and it closed right there. And then as of, 3:15 today, the whole week's gains were lost in one day. Right? Unbelievable. Now, almost all of the move higher happened on Wednesday, and almost all of the move lower happens on Thursday. So it was an unbelievable week. But still, you're not getting above that 20-week exponential moving average line, so it's neither here nor there, and RSI is still well below the 50 line. So if you're looking at it on a weekly basis, you don't really care. Really, if I was looking at this on a weekly basis, I would be glad that I wasn't looking at it intra-week this week, because it's been a crazy week. S-Fund, same kind of thing. We had a big move on Wednesday, finished at the top, closed at the top, and then today took back all those losses and then some. And now we're back to the 30 line on RSI. No point on a weekly basis in being in the S-Fund at this point. I-Fund, same thing, not a surprise. This is where we had a big rally Wednesday, closed up there above 70, and a huge move lower today. F-Fund, same thing. A lot of people thought we were seeing some kind of, because these are weekly, right? So some kind of support there, right below that 103 level. But then
just fell apart.
It fell apart. I mean, as of yesterday, we were right on 103, right, on the close yesterday. So it looked like we were going to get 3 consecutive weeks of, some stabilization there at 103. But as of today, anyway, nope, it's down to 101.77, which is a huge move. I mean, 0.89% on the F-Fund in one day is a huge move, whichever direction you're going in. So, yeah.
Questions.
That's about it. It's been quite a week, and there's still another day to go.
Yeah, it's this is a heck of a time to be going into. Hey, let's shut the TSP down.
Oh, that's another whole thing. If
you've been under a rock,
yeah,
and you don't know that the TSP is actually going to shut down over Memorial Day weekend and open up, we don't know when.
First week of June, they say.
Yeah. Then, this is a heck of a time for this sort of thing to be going on in the market.
Yeah. It's so painful because honestly, I pull up different time frames of charts and I'm looking at different things and look at different indicators, and I still am hopeful, much as I hate that word, hopeful that we get a pretty good rally in the fourth quarter, if not the second half of the year, right? Mm-hmm. So I want to have the ability to get back into the market as soon as possible.
Right. I'd like to have that opportunity. But
I don't know that I can stomach being in the market
and having no control.
Because, when they go dark on that TSP site, you can't call the help desk, you can't get online, like nothing. And then when TSP.gov comes back online, you have to redo your username and password. Mm-hmm. 6.5 million people have to do that. I mean, it's not. I hope it's seamless and all the other stupid buzzwords.
Not trying to be a pessimist, but the logistics involved are going to be extraordinary. Yeah. So, hey, guys, if you like what you see, share it with your friends. If you have any questions or comments, you can send us to them wherever you find this video. You can hit us up in the comments on YouTube, Facebook, wherever. Or if you don't have a comment section wherever you find this, you can hit us up on the email. Yep. support@growmytsp.com. Hope you got a lot out of this show, and we see you every week, Sundays, 6:30 p.m., all over the internet.
All over the interworlds.
All right, guys. Hope you have a great week. We will see you later.
Later.
Music cue. It's kind of loud.